just a couple of things to say at the outset. One is Mark, who unfortunately just had to leave, Mark Yusko from our keynote, made a point about millennials and 50% of their asset allocation being in Bitcoin. I think as a millennial and an asset allocator, the other 50% is definitely in marijuana ETFs. But we're not talking about that today. Whether we're using it or not is a different question. So, look, really great panel. We're not going to listen to me talk very long. We've heard enough Irish accents already. I actually want to pick up on another thing that Mark said as the opening question, and I'm going to put it to Phil, which is AllianceBernstein manages $600 billion. It's not chump change, $400 billion in institutional, $100 billion in private wealth. Is he right in saying that institutional management and private wealth management is dead, or what do you think about that? Because I should probably report back to the CEO if it is.
I don't think it's dead. I do think that, having come from more of a traditional asset management space, more on the institutional side, I do believe that cryptocurrencies or crypto assets or blockchain assets do have a place in everybody's portfolio. It really depends on the risk tolerance, and being this early in this environment, it's probably a very small allocation right now, but that'll grow over time as we get more clarity on regulations. We get more products for custody, and just overall understanding of valuation of the assets. So I think that it's not dead. I think that, depending on risk tolerance, there should be some allocation in there.
And so while you're talking about valuation and methodologies for thinking about that, maybe just give us 60 seconds on what you guys are doing and how you're thinking about valuing cryptocurrencies for investors.
Sure. So Flipside Crypto, what we do is we really analyze the blockchain data itself. We have proprietary data sources that we pull in blockchain data and evaluate cryptocurrencies or crypto assets on 3 different platforms. One is developer activity. We extract data from different open source data repositories, and we dig into that to see how many developers are on there and different developer scores there are in that space. And then in addition to that, we also take a look at utility, what's actually being utilized versus what's being speculative on the exchanges. And then we take a look at market maturity, meaning how many different trading strategies on these exchanges are being used for these different tokens. And then we evaluate and kind of score our assets. And then we put those, that then determines our portfolio allocation that we do for our private 3C1 funds. The funds that we have now are more of a broader based. We take a look at 3 or 4 different segments of the market, and then we allocate to those assets based on this different scoring methodology. We're not big fans of market cap type strategies based on the supply of the different cryptocurrencies that are out there. Market cap can stay the same, but price can definitely fall as more tokens are released into the market. So we stay away from market cap and we look at more fundamental analysis.
So I'm going to ask you the next question, which actually, again, to build on that, somebody in a previous panel said that 94% of the value of Bitcoin is based on the number of users, which sounds a little like the greater fool theory to me, not fundamental value. So at Circle, you guys are working on baskets of currencies for all types and sizes of investors. How do you guys work with your customers? I think you have about 7 million clients, and so how are you kind of approaching that problem?
Yeah. Also, just to quickly comment on allocation. We still are early in the space. I actually have been around for a little while. I got into this like 5 years ago, and right now we're kind of in a bear cycle. So just like kind of keep that in mind that like in 2015, 2016. We saw the same thing that was even worse. So right now we're kind of in a bear cycle, and that it'd be a shame to miss out to have some sort of allocation of this asset class. As Phil mentioned, everybody knows it's a very, very risky asset, but the long-term holders really have been rewarded and will continue to be. In terms of like how we value an asset. So my role, so I work for Circle, and then Circle owns an exchange called Poloniex. So Poloniex at one point was the largest exchange in the world by volume. And so what my job is to figure out which token we add next to Poloniex. So we have about 60 different assets on Poloniex, and we look at a number of different things. So when you're looking at a token, like the first thing that you want to look at is the problem that it's solving. So we could look at a more holistic view on, its competitors, and actually does the problem solving do well with decentralized ledger technology. And so there are a lot of these companies that are trying to do different things that may not be solving a problem that needs to be solved through this technology. So, and we look at a number of different things. The token sale itself, we'll look at what the distribution was like, how much the team holding, what the vesting period is. As Phil said, we look at developer activity. That's really important. We look at a GitHub repository, for example. That's where people are uploading their code, and we see who's committing code, making commits, and who's actually how distributed that team is. And then obviously the team is really important as well. So yeah, we kind of wrap this all up. We put it into Poloniex, and people can trade on it, and it's a pretty cool job. And that's definitely take your time when choosing your token.
So I'm going to ask the general question, and I might even open it up to what is a very lively audience this afternoon. But I'm going to start down the end of the line with just the fundamental question of, as an asset allocator and as asset allocators, how should investors, whether they're institutionals, high net worth individuals, or Joe on the street, how should they be thinking about making this part of their portfolio in terms of size, and in terms of, I guess, two questions: size, and from where should they draw out assets to make this? If it's 5% or 10% or 15%, where does the money come from? Out of which asset class?
Sure. I think you look at the characteristics first and foremost. So you look at it just like any other investment. What's the risk? What's the return? I think you start from there, and then you tack on your individual risk profile. So do you know a lot about blockchain? Yes or no? If the answer is no, then you want to be lower on the scale. It's just you need to use common sense. So if we want to apply that to, okay, where does it fit into the scale of, here's 100% of my assets, maybe I've got 40% stocks, maybe I've got 50% bonds, and I've got 5% alternatives and 5% private equity. I think there's two different spots. I think cryptocurrencies themselves, the ones that Mark mentioned today, the top 12 that are actually currencies, I think you compare those to the currency markets, to gold, and you take some part of that and say, okay, I'm going to take 20% of that allocation, shave it off, and put it into cryptocurrency. And then you can look at the rest of the market if you have the understanding, if you have a way to access that, and we can talk about that later. You say, okay, here's the utility token spot, here's the things that are a little bit further down the list. I may or may not understand those, but if I do, I think I would liken those mostly to private equity or angel type of investments with high risk, high return profiles. So in general, you want to have those as a low part of your portfolio, and I think that's the way you should approach it.
Yeah.
Yeah, I would say if whether you're institutional or retail, I think what you want to do is, again, look at your risk profile, understand what your knowledge is of the space, or whoever your advisor is on this space, and you want to carve out of your highest risk allocation. This is where this is where it would go. I would also say that within this space, there's also, like you said, there's currencies, there's utility tokens, there's asset tokens. Really kind of do a top-down analysis, figuring out what of those sectors you want to be in, and then as we've talked about before, kind of do a bottom-up analysis and really kind of dig into the fundamentals of that range of tokens within that sector. Which ones do you want to be in? And it really goes back to more traditional asset management, but now looking at these new type of blockchain assets.
At Circle, you're making what you're doing available to everybody, and so in addition to the asset allocation question, which you guys are not necessarily looking to solve on your own, how do you square the circle? I didn't intend to do that, sorry. How do you get around the notion of consumer protection? So maybe the allocation question first, and then we'll get into some of the consumer protection.
Yeah, in terms of allocation of a portfolio, I simply just say no more than 10%. That's kind of how it is. And there are different ways that you can get exposure, and looking at the industry, the way kind of things stand right now, it seems like the technology for the vast amount of these assets is still behind where the market is, or maybe not is, but where it was maybe last year. So it's important to go with like the stalwart, assets, and having some sort of exposure to that. Like getting into the ICOs and everything, like and making 500% in a day seems like it might be kind of over for the time being. Maybe when the next frothy cycle comes through, then there could be some exposure.
So in the meantime, we should go back to playing the lottery.
In the meantime, just buy some of the, I don't want to specifically say the assets, because I guess, obviously buy the top, market cap assets that have the most developer ecosystem and that are building it. I mean, the technologies themselves still have that leave a lot to be desired in terms of scalability and security in a lot of cases. So that's important. And then what was the other part?
Consumer protection, and I know that there are some strong opinions on the dais here. So.
Consumer protection. So we, looking at, for example, the security token space. It's really important that there are standards kind of set up across the entire industry. And I'm looking at a lot of different tokens that are kind of setting that security standard, but that standard should be across everything. And so what we at Circle have been doing is throwing our hat in the ring and talking to regulators, and we've recently joined a group of other companies to kind of get the standards across the world to protect consumers, as well as get the regulatory framework in place. So
I will say I read the disclosures on Circle's website, and right before I fell asleep, I didn't feel necessarily more protected, and I was agnostic as to whether I was an individual investor, not accredited, an accredited investor, qualified purchaser, or an institution. And it sounds like from the conversation today so far, the most successful issuances that we've heard about have been limited to the upper levels, whether it's accredited investor or above. Is that the right thing to do? Are we limiting, unfairly limiting exposure to consumers, or?
Yeah, no, I mean, that's the whole point of this entire industry, is to bring the power from these large centralized entities, including the wealthy individuals, down to, somebody who's just, interested in the technology, wants to, buy some tokens. But in the real world, sadly, that's kind of, as a regulatory environment gets clear, it's something that we have to, and these companies need to follow, at least within the US. I mean, there's many different companies or different countries that are kind of moving in some good directions in terms of the regulatory framework, and it's the U.S. We're working hard to get there, but a lot of these companies are kind of moving over to other countries like Malta, Singapore,
Ireland.
Hong Kong. Not Ireland. So,
everybody else has gone there for tax reasons.
France is actually they just came up with some pretty clear guidelines. So we're still working on it, though.
So you guys have both worked with regulators, with the SEC and with the National Futures Association. Maybe just give us a little bit of a sense of what those conversations have been like, who's educating who, where we are today, where you're trying to get to.
Well, yeah, I'll go first. So we have a private fund, and we invest in a lot of the different things in the blockchain space. And I think from a consumer protection standpoint, one of our goals is to go from this framework that the regulators have created over the years for these private funds, which probably a lot of you in the audience have invested in various different asset classes, to take those protections, to take that case law, and to take all those things that are actually good things, and to get it to a point where we can bring it down into the retail investor, and package that and not break the bank for ourselves, and actually be able to run a business. I think that's the next, and I think that'll happen. And I think actually it's a pretty good example. What Siren was talking about before, what COSIMO has done. There's a couple other funds that have done it as well. If we can get these things into blockchains where we can get many numbers of people in to a fund and have it be economical, I think that's a big next step. And then in terms of the regulators, it's of course it's a burden, but I think they are trying to reach out to funds like ours and really educate themselves and figure out what we're investing in, how we're investing in, are we doing due diligence, what kind of due diligence are we doing, like what are the return profiles of these things, what are the caveats, and they're literally just trying to figure out what they're dealing with so that they can hopefully make good regulations. So it's been a good dialogue, and hopefully we think that we're paving the path for the funds that come after us, so it's an easier ride for everybody.
Yeah, no, I would say, having worked with the SEC on educational issues in the past, in a previous life, that the regulatory bodies, they want to understand stuff. They're coming into this, they don't understand. They're looking at the actual experts that are dealing with it on a daily basis. They pull all that information together and then come up with what they believe to be, good regulations. That being said, I think we're at a point now where, what does this all fall under? Like I mentioned before, if you look at the different sectors in this market, what's a utility token versus a currency versus a security token? I think, who really regulates this? Is this the SEC? Is it, the IRS says that it's property? So I think really need to kind of dissect the universe as it is now and figure out what segments are monitored or regulated by each of those regulatory entities. And then from there, you can kind of come up with some consumer protection. That being said, our funds are limited to accredited investors only. And we've had a discussion offline that that doesn't necessarily mean that that's the more educated investor. That just means that they have the ability to actually lose that money and not have to worry about it. So I think that as we get more and more into this and regulators really dig down and understand what's going on in this space, the regulations will come through for consumer protections. I think with FINRA either being a broker dealer with suitability rules and so forth, that kind of plays a role. The SEC with their consumer protection, that plays a role. Money transmitter being state by state and not global, that national, that does kind of pose some different issues in terms of consumer protection. So I would see it going more towards the SEC or FINRA for regulatory issues rather than state by state on a money transmitter law.
It sounds like we're hearing that regulation has value in this space one way or another. And I will say that the history of self-regulating industries is not littered with glory. It really doesn't have a very good track record, whether it's legal, medical, financial, oil and gas, anything like that. So from our perspective at a global asset management firm, while we have shied away from cryptocurrencies, we have been working with the various regulators both in the US and overseas to try and understand how we can begin to provide advice around the use of cryptocurrencies in their portfolios. So I'm actually going to switch tack for a little bit, for a minute, because all of you are involved not just on the investing side of what you're doing and interacting with currencies, but you're also very involved in each of your firms on the sort of structuring and compliance side of things. And so maybe just give us a quick sense of how the use of blockchain technology is actually changing the either the operational efficiency, the economics of your businesses, the number of people you employ. How is that playing out for you as you build up these new business models? Should I start at the end?
Okay. I'd say that it hasn't quite gotten to us yet in our day-to-day operating the fund, but what I would say is that we have invested in a couple of different things, one of which was already mentioned, so I'll say it. It was the Gecko compliance module is something that we're really looking at. It's designed for hedge funds, and that would be something where we can get all our due diligence, and the benefit is it's all time stamped on the blockchain, so it can't be changed. And the regulators can get a password directly into it. So it takes our operational burden way down. I mean, whenever we get a regulatory request for whatever reason on an investment or on our fund, it's, 10 different questions, and 3 or 4 hours later, it's 11 o'clock at night and I'm hitting enter. This, you can literally give them a login, they can go in, they can look what they want, but they can only see what they're permissioned to see. So, that's one thing that I think that we are looking at as we grow. Is a possible solution that blockchain could.
Your lawyers must love the fact that you're replacing them.
What's that? Yeah, right.
Sorry,
they'll make it some other way. Don't worry.
I would have to agree. I think that in terms of blockchain technology on the fund process, really we've only seen it more on the KYC AML onboarding process. We've seen a lot of different products there, but the rest of the process is still rather manual. So we like to see that come in. I do see blockchain being very valuable to the traditional asset management space in terms of trade settlement. I mean, in any equity portfolio manager or a fixed income portfolio manager having to abide by client guidelines, purchase an asset on inventory through Bloomberg or through a broker dealer, and then instructing their custodian to actually set up a trade and take it in, and the other custodian to take a trade, that could all be translated onto the blockchain. So I think the traditional asset management is definitely looking at this space. They might say they're not, but they have people in back rooms already looking at it. There is a straight through processing that would definitely help in that space there. So, I do think that it is coming. It just, we haven't seen it yet.
Yeah. Circle, we take compliance very, very seriously. So, we have about 300 employees at Circle, and we have a decent amount of people who work solely on compliance. So in terms of hiring and investment is actually quite significant. In terms of blockchain, that could actually help the compliance process. As Phil mentioned, there's still some early technologies around KYC and identity that is getting put on the blockchain, but it's still quite early with that. So beyond KYC and identity, it's that's really all we've seen. I mean, in talking a little bit about blockchain in general, or like Bitcoin or Ethereum or whatever, these transactions, it's public. You can see who is transacting with who, even though it might be anonymized by a string of numbers. It's not like cash, right? It's like people. There's forever records of these transactions. So in terms of being compliant, there are people who were trading on Silk Road in 2011 that were doing nefarious things that are still, are now being oh shoot, I shouldn't have posted my Bitcoin address, and now they're kind of getting in trouble. So something I think the dark web view of crypto, the cypherpunk view is actually sometimes overblown, basically, on how cash is versus cryptocurrency. So something to think about in terms of compliance.
Final sort of area to come back to this sort of asset allocation question. Currency is sometimes a misnomer for cryptocurrencies, in that I can't bring my $6,500 Bitcoin down to Mr. Dooley's after this and buy $6,500 worth of Guinness, although that sounds like a fun time. But something like stable coins does bring a new aspect of asset allocation value to portfolios. How has that played a role as it's sort of the latest iteration of these currencies? How's that played a role for you guys?
Yeah, so stablecoins is quite a large part of Circle's strategy. We launched something called US Dollar Coin, which, as you can guess, is backed by US dollars. So right now,
Mark said they're worth 98% less than they were. Sorry.
Well, I don't know if anybody's heard of Tether. So Tether is the first stablecoin, and there's apparently some issues with Tether in terms of trust, that there actually are the assets to back it up. And so now the proliferation of stablecoins have really become part of this market. And so something at Circle that we've done which is quite interesting, is we've created the Center Foundation. So going with the decentralized aspect of this entire industry, any company can join the Center Foundation, the Center Consortium, and actually be part of it and be an issuer of the stable coin. So we actually joined with Coinbase, so Circle and Coinbase. So we've been kind of two competitors for quite some time, and now we're working together, and it's really good in terms of allocation. Basically, the best way to use stable coins right now is a hedge against volatility. Getting in and out when you need to. Let's say you had a bunch of Bitcoin and went up a lot. You want to get out of it, you can do that. But there's some future things about it. So.
What do you guys think? Any final thoughts on stablecoins?
Just on stablecoins alone, I think really, if you're going to be in them, really kind of look at how they're set up. Is there really assets backing them? Is it more of a play of playing with supply in order to match demand so it does stay stable? Really kind of do due diligence on that. I don't see much of a value unless you are, like you said, clearing your positions at the end of the night and being stable overnight until you can get back in the next morning to trade into the other assets if you are an investment fund. But other than that, until we start to see more consumer use of using a cryptocurrency to purchase certain assets, More stable coins, I see them as just a way for portfolio managers to kind of, hold assets on the side until they are able to invest them.
Any final thoughts?
I'd pretty much echo that. I see it as a utility and as a way for traders to square positions if they need to. One other use case that we were talking about earlier with somebody in the crowd was the fact that you could potentially use those in security tokens to pay dividend payments or interest payments out to people that are holders of security tokens. If they don't want to do the math and they say, okay, I'll buy the security token that you told me about, but I don't want my interest payments to be in Ethereum because I don't know what that is, or I don't want to have to worry about the market fluctuation. You could receive a stable coin and know that it's going to be pegged 1-to-1 to the dollar.
That's actually, I'd never heard of that. It's an interesting use case and potentially some interesting tax avoidance strategies around paying a dividend with an asset versus paying it out in cash. But the buzzer here is screaming at me, so I'm going to be hooked off stage in a minute. But I'll just finish with one final thought, which is to sort of circle it up in an asset allocator's standpoint. One of the things that we've been thinking about is that cryptocurrencies and blockchain investments, in some ways as a replacement for venture or private equity, are analogous, even though unfortunately cryptocurrency suffers from the mark-to-market volatility that venture doesn't. But if we saw, I think, the ticker of the value of our venture investments every day, we might think about those differently too. So thank you to Ben, Phil, and Jed, and thank you all very much.